Okay, part two of this video. Where are we? Here we are. Replacement cost. Right. So I think I mentioned replacement cost earlier. Replacement cost, as you can see here, it says the replacement cost is the cost to the entity of replacing the asset. However, in a non-current asset situation, you will need to determine the asset's net replacement cost. Think of insurance. Imagine you had an asset, right? That you bought this asset and it was supposed to last you for 10 years. I think I've given a similar example in the previous video. You've gone 3 years and something happened to the asset and your insurance company turns up. Your insurance company will typically give you an asset that is of similar value, of similar kind of age, so to speak, right? Because that's what they're obliged to do. They're giving you kind of the extent to which the value of what your thing you have, what its value is. They're not going to give you a brand new asset. So for you, the value, so to speak, is to say, okay, what's the value of a new asset? The value of a new asset would have been something else, and you will then depreciate that new asset up to the period, the current value of a new asset up to the period that you have depreciated so far, or that you've used the asset, because the insurance company will give you something to replace your current asset with similar value and similar age. Which means that when we tackle replacement cost, we always find the new value, the current value, and depreciate by the length of time we've had the old asset to get if you like, a replacement cost, so to speak, to sort of show off or give to the insurance company. So I give an example here. For example, an asset with a historical cost of 500,000 and a life of 5 years. Here we are. Would have a carrying amount at the end of year 2 of 300,000. So we have here 1, 2, 3, 4. So if you like here, 500,000 each year, you're basically dropping, aren't you, by 100,000, right? And then you have 0 over here. So the carrying amount, of course, like I say, after year 2 will be 300,000, 2 years of depreciation. Now, if the current purchase price of an equivalent new asset is at year 2, so insurance company, something happens to your asset, insurance company says, go away, come back and tell us what the value of your asset is. So you would then say, well, a new asset would have cost 600,000. Technically, we would have had it for 2 years. So I do exactly the same thing. So I sort of say, well, then that's 600 over 5. That's what's that? Well, that's 120, isn't it? That's 120 each year. So 600 from 120, that brings that to 480,000. That brings us to 360,000. That brings us to 240,000. That brings us to 120,000. These are just the net book values that I'm doing. So the replacement cost that I go to the insurance company would be, listen, to replace this asset, it would be 360,000, if you like, and that's the way we would look at that. You see, the problem here is that we're trying to stick to the cost structure as much as we can, and also sometimes these are very unique assets, and you can think of it that way. I guess insurance terms, what would happen is they'd give you some extra money as well, and you go away and buy a new asset, but the replacement cost of the asset itself is 360,000. And that's how we calculate replacement cost. So we have, again, we have other ways of looking at this. Again, of course, we've done net realizable value, which is a fair value less cost to sell, of course. That's just, we've always done that. That you could recognize it at fair value less cost to sell, if you like, if it's lower, right, than the carrying amount. Or, of course, we've talked about value in use, which is the present value of the future flows. So this is just a question for us to look at. Yes, right. So this question here. So it says here, a company owns. We're going to do all of them. A company owns a machine which it purchased 4 years ago for 100,000, and they tell us that after 4 years, the accumulated depreciation is 40,000. So this one is pretty straight. As far as the historical cost is concerned, it's just the 100,000 minus the 40,000, isn't it? Because that's 4 years of accumulated depreciation. So the net book value is 60,000. And then we have that historical cost done. The net realizable value is what we can sell it for. These are things that we've been dealing with for a while. The net realizable value is here. It says that you can sell it to someone else for 50,000. but it would require dismantling costs of 5. And so therefore you and I know that it must be the selling minus the 5 grand, which gives you that net realizable value of £45,000, right? And that's the net realizable value. Replace the machine with a new version, which is what I was saying here. In terms of the replacement cost, when we calculate that, we sort of do what I said earlier on. We take the 110,000 and basically, where are we here? So I guess from here we could see that this was a 10-year period, wasn't it? Because if it said that you purchased it 4 years ago and you have depreciation of 40, gives us a sense that this is a 10-year thing, isn't it? And therefore, 10-year thing would be, if you like, 11 4 times, and therefore the replacement cost would be 110,000 minus 11 4 times, which is 44,000, which gives you 66,000. I would go with 66,000 there. 110,000 minus 44,000. Yes, which of course is equal to 66,000. Then the economic value, I'm going to go to the text because I've done this video, really is looking at the present value ultimately of what's going on here. So it tells us that the cash flows for the existing machine for the next 2 years, it's kind of like for the next 2 years. So for the next 2 years will be 25,000, and then 20,000 for the remaining 4 years, which is why they give you all of this. So literally, if I multiply that, I can find the present value, which is what that's saying. The economic value is what is the present value times 2.619. So if you do all of that, and I'll take you to the answers in a second, if you do all that, you will be able to see what the present economic value is of all of that. So let me take you there. Oh, actually, yes, I think here it is. So we've done that. We've seen that's the net realizable value, which we calculated. That's the replacement cost. And that's me multiplying all those things as you saw. And those are the figures. And so the economic value is 95,755. So to a certain extent, all the things I've just done here are very much related to the things we've always discussed from a historical cost kind of concept, and all relate to the historical cost, if you like. Yeah, so the historical cost, the net realizable value, the replacement cost, don't forget that, and the economic value is really the present value of all those future economic benefits which we see given to us here. Okay, I think that's a good place to stop so we can start the new sort of looking at, we're sort of moving away from historical into a more current value approach, to look at this in the next video.